comparing it against the index doesn't make an awful lot of sense. Simply from a volatility perspective, you're not going to be able to get a spread trade that works against an index simply because of that reason. The way we try and minimize, of course, the downside risk on the cats is to obviously demand an extra bit of money from these trades. But you've got to remember that the reason why we're talking specifically about things like the cat discount stocks is because you've got to remember that when bad news comes out, the question I asked everybody in this room is that when bad news comes out, what's the chances that the insiders didn't know about that news? Well, of course, there's always a chance that the insiders didn't know about the news. There's always that chance that it's caught them by surprise. But really, 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 what's the chances that the insiders didn't know about the news that was just about to come out regarding their own company? The chief executive officer, the lawyers, the managers, the senior directors of the company, the top shareholders, the owners of the company, they know. These are the guys that do know. If anybody knows, these are the guys that do know. Even things like audited accounts, earnings, the owners know before what's happening because the accountants talk to the owners, of course they do. So one of the things you've got to remember is on a bad news story, what you're looking for is you're already looking to see that some of the losses have already been priced in. Some of that bad news has already been priced into the price of the market. In that way, in some ways, we can verify that there is a probability that it's already been priced, it's already been taken, it's already been traded by the insiders, the guys that really know. So when we get an additional discount, when the street finds out, and we get all this massive news coverage for whatever reason, positive or negative, when we get this huge, massive news coverage, what's going to happen, of course, is the market makers are just going to play the game to get as much liquidity on the right or wrong side as they need. And that's exactly what we're trying to take advantage of in these cat type trades. Now, this was a cat call that we did on a few days ago. It wasn't that long ago. It was one of our cat discounts, as you know, before the cash open. And this was one that we did take, and because we got the exact discount that we needed, we got the wholesale price. Remember that $20.50 level we started to buy into, and you can see that the stock had been selling off for 3 days prior to the bad news. So this is something you might say, but what was the index doing at that stage? Well, the index had actually been up very nicely. This is the S&P in the background, of course. So when you see that the index had actually been up very nicely over the previous 3 days, it's not a stock correction that's taking place, as in a market correction that's taking place. It's a specific stock correction that's going on in the background. Now, some might just say it's a bit of profit taking from this big high, but it's not a bit of profit taking, is it? There was a very, very large sell-off on that stock from a high print price of $36 down to $23. That is not profit taking. That is somebody getting short the stock for the bad news, probably the insiders. And that selling is going to find its way into the knowledge bank of the liquidity providers, the market makers, the guys that do this bit of business, hence the reason why the price ends up down at these kind of levels in the first place. So when the street finds out and everybody says, whoa, bad news, it's like a news release coming out of OPEC. You can guarantee that the Saudis and the Iranians and the Iraqis and the Kuwaitis, they've already traded it, okay? So don't be surprised when a bad news story instantly goes in the opposite direction after the news comes out. So when you see these types of, when you see these types of information, when we get the bad news story, the probability is that the market maker is going to have most of that already in the market. They've already got it. So therefore, when they do discount it, that's really a big discount for us, because realistically, the price should probably be trading where it's at just now on the basis of the news already available to the insiders. So when this stock opens, of course, one of the things that we do on any of these discount stocks, first of all, we can tell whether the index is collapsing, in which case we have to be cautious of that type of thing in the background. But one of the things that we do when we see this is we simply ask for that discount. What we do is we take that closing price just there, We take the opening price just there, and we try and figure out where the 25% discount is. And we just go in amongst that area and we start asking for that discount price. Now, we look for the nearest wholesale price, which is $20.50, and we start buying that discount, bearing in mind that the news should already be in, and assuming we start seeing buyers coming in this area, we see big volume hitting, the insiders will now be using the bad news to do what? What will the chief executive officer be doing? What will his family be doing? His buddies at the golf club, what will they be doing on the bad news? They'll be bidding for the stock, right? They'll be bidding for the stock at a discount, just like we are. So when we're bidding for the stock at a discount, this is the price we're paying at $20.50. We're joining the members of the golf club, and we're getting a bit of information. We're getting a little bit of information from this gap down, and we start buying some $20.50 stock. And as you can see, a short period after that live call on Very, you can see what happens to the trade. We get this continuation trade the next day. We get a very strong bullish run, surprising. After a bad news story, we get a very strong buy side pop, and then we get another buy side pop all the way up to a high print price yesterday of, as you can see, $32.50 from a buy price of $20.50. That's a $12 profit. $12, guys, on a $20 stock. In other words, 60% return on your account on that one trade over the course of 3 days. Maximum swing, of course, maximum swing. If you decided to hold the trade, if you were not wanting to do just individual day trades, then if you decided to hold that trade, then it's a 60% maximum swing on that stock from that discounted starting point. And if you don't think that's good, I don't know what guys you're trading, because it's better than Bitcoin. It's better than any of these other markets. It's a fantastic gain, 60% return on your account in one, and literally in one big swing made up over the course of 3 days. Now, as I said, whether you decide to trade that and hold it or not is entirely up to you. It's not supposed to be a buy and hold strategy, but obviously if it closes strong each day, you can obviously do it if you want to take it as a buy and hold. And a lot of people will advertise this and say, look at what you could have had if you had seen this type of information here. Look at what could have been seen at the open. Look at what you could have had on that trade, and they'll point to these trades after they've already gone and made 60 percentage points. Instead of which, what we can actually do is we can show you the tweet with the time on the tweet. 2:19 on the 3rd of December, 10 minutes before the cash open started. And there's the stock right there, ticker symbol VERI, ticker symbol Very. There's the stock. So we can go into it. It's our number 2 pick on that occasion. It's the perfect price at the perfect level. We can go into that stock before the cash open starts and actually do the trades that these marketing geniuses seem to always come up with after the event, what you could have seen if you had bought this or that or whatever by using our process. But they never called the stock. They never called the stock at all. They never just did that. They simply then highlight it after it's already made of a gain, and then looked at what it was that caused the big gain, and then said you could have potentially have had that stock. Bollocks. One of the few places you can actually get in on these stocks is right there. You can see that we are looking at this as a possible discount play, and we know how to trade it properly. It doesn't mean we think it's going to go racing to the upside, but obviously it means that we're in it if it does go racing to the upside. We're not saying that these discount stocks are going to go for 60% or 70%, or as was the case in one of them, 1,000%. We're not saying that. All we're saying is if you've got a chance to trade it, you can trade it. The second question, of course, was, well, on that basis, what else? What do we trade as a possible peers trade? Here's one, by the way, that didn't go ballistically good to the upside, but it was a discount stock from yesterday as well. Is this stock here? you can see that this didn't pick up any gains. And you can see that it was sold off ahead of the bad news, and then we got more bad news. How much bad news is this stock going to have in it? Well, guess what? This isn't a stock. It's natural gas. This is natural gas. It's not an individual stock itself. It's just saying that natural gas is falling. So you've got to make sure that you put that into your knowledge banks. It's not an insider trade. It's a natural gas ETF. Yeah? So, something to remember. Now, one of the other things that we were talking about was, and we'll go back to our old friend Tesla, and it was this trade here. And the question was about Tesla. The question wasn't about Tesla, but the question was, what stocks could we potentially pairs trade against an index? And the answer to that question was, well, the upgrade stocks. The upgrade stocks, yeah? So when we're thinking about the upgrade stocks, this is what we try and obviously identify for you guys before the cash open again, believe it or not. Take a look at this little tweet here. Same date, 3rd of December, 2:20, 10 minutes before the cash open. We had Tesla, TSLA, a buy stock by Goldman's no less, right? So what are we going to do with that information? Well, most of the time these stocks will have a bit of a gap attached to them, so we don't want to trade the gap, but we do want to trade it as a pairs trade against the index. You don't have to trade it as a pair, but obviously trading it as a pairs trade against the index is one option if you want to trade pairs, if you want to have a little bit of hedging against some of the bigger name stocks. So this is something that we can obviously pay attention to. But here's Tesla right there, 10 minutes before the cash open on the 3rd. Tesla was trading at $585. Since then, of course, it's went up by 70 odd dollars on a $500 stock, so around about just over 10 percentage points for anybody owning Tesla on its own without leverage, of course, 100% in the stock itself. Now, why would you be able to buy Tesla? Well, take a look at the index. So we're now zooming in on this trade here. So one of the things we try and do with these stocks is we try and buy them at good wholesale price levels when the index is bullish, because these are buy stocks. These should outperform the index. Now, the gap up is obviously going to outperform the index, but short term, we also want to try and find these stocks when they underperform in the short term on a day trade basis. Because if I want to, I can now try and pairs trade that against the index itself, even on a day trade basis. So for example, if the index is rallying and I see Tesla getting profit taking coming in here, this becomes the trade for me. I want to buy Tesla into the low price of the day. The index is still very strong. So I start buying Tesla here. Now, what could I do? I could obviously see Tesla rallying behind the index. I could see the index maybe starting to pause. Maybe there's some reasons to be selling the index, and I could sell the index up here. I'm now in a pairs trade. And what I'm now betting on is I'm betting that Tesla is going to outperform the index itself. So obviously what happens is the index drops down and makes you a profit on the short index position. In the same time, Tesla rallies and makes you a profit on the Tesla position. What could you do with that information? Well, two things. You could either close off your index on the basis that you want to be long Tesla. You could close off the index, or you could just leave them both at stops at break even on the basis that Tesla should always outperform the index. So what's probably going to happen is if Tesla catches a very strong bid on the back of equities going higher, the equity short position is going to get stopped out for break even. You're going to end up with a double alpha trade or a break even, worst case, on a rise on Tesla. And what happens, of course, is that the index continues to drop aggressively and Tesla continues to rally. What I normally do in this type of situation here is I'll take half of my Tesla stock out. I'll take half of my, I'll take my whole S&P position out, and I'll now run the Tesla position. Or you'll take half out of both, and you'll put stops at break even on both when you've got a big enough double alpha profit that you're happy with. And obviously, what happens at that stage is that the S&P does get stopped out just here. You see that at that point there, the S&P actually spikes through, gets stopped out. There's some selling pressure coming in Tesla as well. We start seeing some selling pressure coming in at 596, and then we get another chance to do the trade all over again. Same trade. This is not a one-off trade on one day. This is a trade that we can keep coming back to, because Goldman Sachs aren't saying Tesla's a buy trade today. What they're saying is Tesla's a buy trade. They've probably got a new target price of like $800 a share or something, something along those kind of lines. It's not a day trade when we talk about the street positives. So one of the things we're always going to be looking at now is that Tesla should be a buy on discounts against the index at any stage. And here we go. There's the cash open. It drives down. The S&P drives up. So there's your opportunity to buy some Tesla again at $588. So if you had taken some profits up here, you've just reloaded Tesla. If you had taken profits there, you've just reloaded Tesla. You're back in a long trade at $588 and another opportunity to buy a discount against the index. And sure enough, the next day we get this huge gap up. Huge gap up. And sure enough, there we go, guys. And obviously we've had this incredible outperformance. Incredible outperformance during that period. And that's been a great way to think about your markets, guys, against the street positives. So whilst you might not think the street positives are great opportunities, Tesla's a great example, obviously, of one of those great opportunities, because this was obviously a stock pick for us way back yonder when it was $440 a share, now $640. And that's obviously put on approximately 50 percentage points on that rally from yesterday, huge rally from yesterday. But you can see that even after we've came back to Tesla as an upgrade from Goldman's, it's still a great opportunity. It's still a great opportunity then to buy into discounted sessions. Now, is it discounted just now? Of course it's not. It's trading at a premium. So if you're going to lock in profits, one of the things you can obviously do is when you come up into these wholesale price levels is you could potentially, since you own a lot of Tesla shares, what are your choices? Well, if you're still really bullish the stock, you could obviously sell some out of the money calls. Sell some out of the money calls. So you could maybe sell some 675 calls maybe. What about that as a strategy? Sell some 675 calls. Yeah, you own the stock, guys. You're not taking any risks by selling calls. You actually physically own the stock anyway, so it's not going to make any difference. And it just locks in that extra little bit of profit. So you're not having to give away your stocks, obviously, and it's not costing you money if the stock price continues to go higher. You're actually getting a premium for that, remember. What else could you do? Well, you could buy a put option. The only downside of buying a put option is that it obviously costs you money to buy a put option, whereas selling a call option at 675 actually gets you money, gets you a premium against this huge profit that you've already got in your books. And now you can sell premiums against that Tesla stock for the rest of your life, potentially. Every time Tesla starts going up with the volatility that's in it, you'll get a very, very, very big premium. Very big premium for every time you sell one of those call options now. And you'll be able to make an income every single week, every single month from Tesla shares that you own. It's like getting paid a dividend every single week, every single month, guys. It's like getting paid a dividend. And that's you. You're in the money now. So as soon as you get one of these big movers, all you now do is sell call, short-term call, short-term call, short-term call, quite a distance out of the money. Because the volatility is still high, you still get a good premium. You make that cash, you put it in your bank account, you potentially buy more Tesla stock, potentially buy more Tesla stock when it's discounted, sell more calls, buy more Tesla stock when it's discounted, sell more calls. And all you do is keep that call distance and duration away from the current price. You may get exercised at one stage, you may end up losing your shares at one stage, but if you lose your shares today, for example, at $675, would you be bothered? Having bought them at $580 or $590, would you be bothered, guys? Of course you wouldn't be bothered, right? Of course you wouldn't be bothered. You'd be delighted to get rid of your Tesla stock at 675. You can always buy back in at a lower price at some stage. So that's one way to start thinking about this as a business, as a way of developing out the fact that you're owning a whole wad of Tesla stock and you're starting to get maybe a little bit concerned about how high it is. There's a lot of ways to trade this now, right? Make sense, guys? I hope so. So S&P top edge, who's with me, guys? We've sold this a few times here. I hope somebody's been joining me on the short side of this bad boy. We've shouted it several times. I think we tweeted the short S&P. I'm sure we have, but we're basically working the short side of these this ABC correction here. We've got quite a lot of ABCs selling off here. We've got a lot of weakness in the markets across a lot of different things. But selling into this it's not been a big earner yet, but you should still be with me, guys. You should still be with me on this, selling into these 77s, 78s kind of area. Who's with me on it? You can see there's been a couple of opportunities to sell into some L3s. There was a big spike just there. We got another bit of sell side response. And as I said, it's not earning us a lot of money, but it's not losing us any cash either. We'll just keep working that short side on upticks type narrative at the moment. Tim's with me. Is that it? Is that it? I know that should be enough, Tim, but I'd like to see a few more people other than just myself and yourself in it. But you can see that selling into the top edge makes a fair case up here, guys. Very, very strong value divergences against this story. I didn't get a chance to trade the break higher on the oil for a short because the euro still hadn't given me much and the calendars had started to give us a little bit of a bid here. There was even a possibility of driving into this as a possible buy trade. You'll probably remember, guys, I actually put this box on the charts for you guys this morning. So this could have been a possible buy trade. However, I didn't buy it because we were still seeing some supply coming in at that stage. So whilst I did draw the box before the price traded into it, I didn't buy into my own box area because of the reason I've just stated. The supply was coming in behind the drop. And as a result, I wasn't going to be too keen to explore that as a buy trade. So for me at the moment, I still can't find a way into the oil trade. We've got plenty of technical garbage going on in the background, plenty of liquidity snaps trying to stop out tops and bottoms. But for me personally, it's not a trade. I'm just happy to stay on the sidelines. Might be a trade down here all the same, guys, going into the cash open here. We've got a cheeky little stop run that broke lower here, but difficult because it was a pretty fast and furious move. And I'd like to see it retesting into very low volumes as we go into this cash, as we go into the NYMEX Open here. I'd like to run that, maybe run the stops, see whether there's any business that falls out of the nest here, and then maybe look at picking up a bit of bid off of this 40, 30, 40, 20, 45, 25 area on the buy side of the book in here. That's what I'm kind of thinking just now, guys, is buy side oil at slightly lower prints than we're getting just now. Sell side S&P, that's another reason why the oil I'm expecting just to go that extra little bit further before I start buying it, because it's sell side S&P for us at the moment, sell side off that top edge that we'd already told you about. And starting to make a bit of sense now. It's got down to the 73 quarters, 73 halves area, which is pretty good.